Picture this. It's a Tuesday night. You and your spouse are sitting at the kitchen table, staring at an envelope. It's not a bill, technically. It's from your mortgage servicer, and the subject line reads, Annual Escrow Account Disclosure Statement. It's arguably the most boring arrangement of words in the English language, but it's also the reason you're about to have a terrible conversation. You open it and realize your monthly payment just went up by a few $100s. But wait, you didn't refinance. You have a 30-year fixed-rate mortgage. Your loan officer kept emphasizing that your rate was locked in. Nobody called you. The interest rate on your loan is exactly what it was the day you closed. So what happened? Here is the secret they don't tell you. The rate is locked in. The payment is not. Today, we're going to break down the trap that gets almost every single home buyer. I'm going to show you exactly how the real estate industry engineers your monthly payment, why your fixed mortgage isn't actually fixed, and exactly what you need to do before you sign those closing papers. Let's dive in. Let's start with the uncomfortable part. None of this is a mistake. It is exactly how the system is designed. Here is the reality of how houses get sold in America. You don't actually buy a house. I know it feels like you buy a house. You tour it, you fall in love with the kitchen, you argue about the commute, but at the moment you decide to purchase, the thing being sold to you isn't a house. It isn't even a price tag. It is a monthly number. Every participant in the real estate transaction knows that you are making your decision based on one figure, your monthly payment. The builders and lenders engineer this basically down to the dollar. Let's look at the big home builders. Some of the biggest builders in the country are basically buying down your mortgage rate instead of dropping the price of the house. Why? Because cutting the sticker price of a house by $40,000 completely ruins the appraised value of every other house in that neighborhood. But if they spend $30,000 of their own profit to buy down your interest rate, your monthly payment drops by the exact same amount. You feel relief, your neighbors keep their high home valuations, and the builder moves inventory. The only casualty, your understanding of what you actually just agreed to. Let's look at a totally average couple. Let's call them Renee and Desmond. They saved up, put 10% down on a $412,000 house, and secured a 6.6% interest rate.
If you punch those numbers into a standard online mortgage calculator, it spits out a principal and interest payment of about $2,383 a month. That is the number they focus on. That is the number that is locked in for 30 years. But now, add everything that the calculator quietly skipped over. Property taxes, $342 a month. Homeowners insurance, $198 a month. Private mortgage insurance, PMI, $170 a month because they didn't put 20% down. Suddenly, that $2,383 payment jumps to $3,092 a month. They adjust. They cut their streaming services. They stop eating out as much. They can handle it. But then, the letter arrives. Here is the exact mechanism that breaks people's budgets, and it happens to almost everyone. When you close on your house, your mortgage servicer estimates your escrow account, which pays your taxes and insurance, using the taxes the previous owner was paying. That assessment might be from years ago. It's like trying to budget your grocery bill based on somebody else's receipt from 2019. Then reality hits. The county reassesses the property at the brand new, much higher price you just paid for it. Your tax bill spikes. Simultaneously, your homeowner's insurance renews 25% higher. Suddenly, your escrow account is thousands of dollars short. Now your servicer does two things at once. They raise your ongoing monthly collection to the new, higher level. They take the shortage from the past year and spread it across your next 12 payments. You are paying the increase and repaying the past shortage in the exact same month. This is how a fixed payment randomly jumps up by $300 or $400 a month. It isn't a glitch. It is the system working exactly as intended. Now you might be thinking, okay, I'll just buy a condo. Less maintenance, fewer surprises. Let's talk about Priya. Priya did everything right. She looked at expensive houses, realized the maintenance would eat her alive, and bought a modest 2-bedroom condo instead. Her principal and interest, plus her $385 HOA dues, fit perfectly in her budget. But post-Surfside, Florida, new laws are requiring strict structural inspections for condominiums. It turns out Priya's building had been quietly underfunding its maintenance reserves since the 1990s. The roof had been keeping score. Her regular dues went from $385 to $610. Then came the special assessment, a massive $41,000 bill for her specific unit, financed over 5 years. That added over $800 a month to her housing costs. Priya bought less house than she qualified for, precisely so nothing could surprise her. But the structure she picked to protect herself was a ticking time bomb of deferred maintenance. So, the payment moves. It's painful, but survivable. Here is the part that dictates whether any of this was actually worth it. Everyone tells you that renting is throwing money away, and buying is building equity. But let's look at what you actually buy in year 1 of a mortgage. Let's go back to our couple, Renee and Desmond. In their first year, they paid over $28,000 in principal and interest. Do you want to guess how much of that actually went toward their principal balance? About 14%. The rest, tens of thousands of dollars, went straight to interest. This isn't a penalty. It's just how amortization schedules work. The bank collects its rent up front. You won't reach the point where your monthly payment puts more money toward your principal than it does toward interest until roughly year 20 of a 30-year loan. This is why the 5-year rule is so brutal. If you have to move after 5 years because of a job change or family reasons, you have barely touched the principal of your loan. If your home's value didn't appreciate significantly, once you pay realtor fees and closing costs to sell the house, you could easily walk away with almost nothing or even owe money at the closing table. I want to pause here and argue against myself for a minute, because despite everything I just said, home ownership genuinely works. It is still a powerful wealth-building tool. Here's why. Forced savings. Almost nobody who rents actually takes the difference and invests it perfectly in the stock market every month. That ugly amortization schedule, it's a forced savings plan that you cannot skip on a bad month. Leverage. You control a $400,000 asset with a fraction of your own money. If the house goes up in value, you keep 100% of the gains, not just a percentage of your down payment. Imputed rent. This is the big one. While your taxes and insurance will go up, your actual base mortgage payment, the principal and interest, really is frozen for 30 years. In year 15, while rents in your city have doubled, your fixed mortgage payment will feel like the best deal in town. Housing is a great asset. It's just a great asset with a very expensive habit. The deciding factor is usually time. If you stay in the house for less than 5 years, the math is tough. But if you clear the 7 to 10-year mark, the financial benefits really start to pull ahead. So who is at fault for the trap? Honestly, nobody. The builder is paid to move inventory. The lender gets paid when you close. The realtor gets paid on the purchase price. The county sets the taxes. And the insurance market prices the climate risk. There's no cartoon villain in the room trying to trick you. There is just a system where nobody is financially responsible for making sure you can actually afford the home 5 years from now. Except you. Here is exactly how you protect yourself before you sign. Calculate your own taxes. Do not trust the online estimate. Find the local property tax rate and multiply it by your actual purchase price, not the owed assessed value. Get a real insurance quote. Don't use the placeholder number the lender gives you. Call an insurance broker and get a firm quote for that exact address. Ask them how much rates in that zip code increased over the last 2 years. Demand the reserve study. If you are buying a condo, read the reserve study. If the HOA doesn't have one, run. That is your answer. Stress test your budget. Add 15 to 20% to your total estimated escrow. Ask yourself, if my payment goes up by this much in 18 months, will I still be okay? We have been trained to ask one single question when we buy a house. Can I afford the payment? It's the wrong question. It assumes the payment is a fixed, immovable object. The right question is, can I afford this payment when it's 15% higher in a year for reasons completely outside of my control? Because that year is coming. Your interest rate is locked in. Nothing else is. The only difference between the people this system wrecks and the people it merely irritates is whether or not they saw it coming. If this video helped you understand the real math behind buying a house, hit the like button and subscribe for more honest financial breakdowns. Let me know in the comments, have you ever been hit with a surprise escrow shortage? Thanks for watching, and I'll see you in the next one.